like Buffett says, investors become like Pavlov's dog. The market opens and they come and eat at the trough of perpetual prosperity. All recorded history defies that. It's never been as good as the last 15 years. That's when you got to be incredibly nervous.
Bill Smead returns to the show. He is the chairman of Smead Capital. We spoke to Bill a few months ago, earlier in the summer. He was calling for a market euphoria to be in the final stages. We'll revisit that call today with Bill. Welcome back to the show. Good to see you.
Thanks for having me.
Stock markets in particular, continue to reach new all-time highs. We're speaking on Friday, October 18th today. The NASDAQ is up about 70 basis points. The S&P is up about 36 basis points, 5,800 points on the screen, 5860 on the screen right now. I'm looking at late Friday afternoon. Goldman Sachs is projecting 6,000 points by the end of the year. So, this is a very bullish environment right now, just based on sentiment and momentum alone. How are you reading what's going on currently?
Well, uh, you know, you kill a financial euphoria episode with a blow off top, and we're definitely the breath is improved, and that is convincing a whole lot of people that there's nothing to worry about. So whether it's the level of participation, the amount of household uh, assets that are in stocks, the psychology, uh, the biblical symmetry, Buffett would say, of the way history would say markets work. Uh, there just isn't any category where it isn't obvious that we're in the late stages of a financial euphoria episode.
What do you mean by financial euphoria? How is that different from a bubble? Is that the same thing, different terminologies?
Yeah, well, let's use Charlie Munger's vignette at the annual meeting last May that they showed to honor him. He said in '99, he said, a financial euphoria episode is like a Ponzi scheme or a chain letter. And he said, if you add a legitimate development, it's like mixing raisins with turds and you end up with turds. Okay, so in 1929, the legitimate development was radio. We went from 1% household ownership of radios in 1923 to 75% household ownership in 1937. The glam stock of the 29 bull market was RCA, the largest maker of radios, one of the two national broadcasters of radios, and one of the two largest programming providers. In other words, they were Amazon, Microsoft, and Netflix all wrapped into one company, their stock hit a peak. It went from 10 to 115 in 2 years, and then in 1941, when we had the most famous radio address in U.S. history, when we declared war on Germany and Japan, and President Roosevelt said December 7th is the day that live in infamy because of being attacked at Pearl Harbor. The radio business was every bit a legitimate success as anyone could have anticipated. But you could buy the stock the day he did that address at the price it was before it went up at $10. Then the next 27 years, it was a fabulous growth stock, right? So you're just the original hype overdoes it, even when you're right. I mean, the internet did change our life. Where's Cisco, the router that Cisco, what it was the only people that had the router, just like NVIDIA is the only one that's got the magic chip or the magic technology. And so it's the problem is not that it's not legitimate. It's totally legitimate. The problem is the euphoria episode overcapitalizes things and doesn't do a very good job of sorting out over 10 years who the winners and losers are going to be.
A lot of people would agree with that. Agree with you that valuations are very rich right now, especially among the tech sector. What, if anything, should investors be looking out for in terms of a trigger for a downside correction?
Well, ironically, I don't think that the tech sector is any more egregious than growth stocks in general. And let me explain to you why I say that. Uh, the uh, Costco is an incredible company. I call it the Mother Teresa of common stocks. In other words, it's a sin to even say anything bad about it, right? So why did it trade at 15 to 20 times earnings for 30 years while it was succeeding off and on that whole time? And why is it worth 53 times earnings now? And the answer is that there is a mania associated with, ironically, exactly what Munger advised Buffett to do back in the late 60s, which is find wide moat, incredible balance sheet, high return on equity businesses, and even if you have to pay a little bit too much for them, hold them. Well, they've all done great. They're all just stretched out like crazy. So I think the damage is going to be far more widespread in PE contraction is really what you're going to be dealing with. Coca-Cola was at 60 times earnings in 1972, and I was pitching at 6 times earnings in 1981. So, did Coca-Cola turn out to be a bad business? No, it's a great business. Buffett ended up paying 5 times that price to buy in at 88, 89. But at 60 times earnings, it was a bad investment for 10 years.
Are you liking this video so far? Well, video creation is challenging. So let me tell you about today's sponsor, InVideo, which is changing the game for video creators like me. And if you're a content creator, then listen up. I know that creating videos can be complex, but InVideo AI V3 changes that. With new generative capabilities, you can now create full-length, publish-ready videos from scratch using simple text prompts. Whether you're telling a story, explaining complex topics, or creating product ads, InVideo AI V3 puts you in control, bringing your ideas to life in minutes. Unlike tools like Sora and Runway that only generate clips, InVideo V3 creates entire videos ready for use, and the best part, it's launching in just a few weeks. With the edit command box, you can make real-time adjustments to your videos. Plus, voice cloning now lets you replicate your voice for narration. If you haven't checked out their current version, scan the QR code here or use the link in the description down below to try it for free. Paid plans start at $20 a month, so use my code to get 2 times video credits in your first month. Get started today. The issue here is right now the bulls are expecting the markets to continue to feed off of dovish Fed sentiment. And it's not just the Fed, by the way. Central banks all over the world are cutting interest rates. The Bank of China recently stimulated. Bank of England earlier this summer. The Bank of the ECB just this week cut rates. Bank of Canada as well. In a declining interest rate environment, though, Bill, is it prudent to expect this euphoria to stop anytime soon?
I'm so glad you brought that up. I'm so glad because we've spent a lot of time looking at what went on from 1969 to 1982 because we think it's the most analogous situation. So, in what we define as the inflationary decade of the 70s, included two massive pullbacks in inflation. One from about 7 in 1970 to 3% in 1973. Then we went to 11%, and then we pulled back to 5%, and then we went to 14%. So we view this as the first lull. There is $12 trillion of federal government borrowing that has been monetized. It's already monetized. You cannot stick it back up into the womb of the federal government. It's out there, it's floating around. We have incredibly favorable demographics 180 million people under 40, which is great demographics for good economic growth. And the problem is, you saw it, they cut rate 50 basis points, but what happened to the 10-year Treasury rate? It's gone up.
Yeah.
Yeah, Druckenmiller was on TV a couple of days ago explaining that he's short bonds.
Mm-hmm.
So the problem is the short rates will go lower, and the invisible hand of the market will define that as an inflationary force. Look, the longshoreman. My dad, Cole's grandfather, was a Columbia River ship pilot. He did not like the longshoremen. He thought they were the most overpaid people in America. And they just got a 62% wage increase over 6 years. And the machinists at Boeing have turned down a 30% 4 year wage increase. Now you tell me, what kind of inflation do you get out of 7 to 10% per year wage increases by two of the more powerful unions in the United States of America?
I saw parts of that Druckenmiller Miller interview. By the way, he mentioned that he sold Nvidia early. He regrets selling it early. He will probably get back in if it dipped down much lower. Do you kind of share the sentiment of missing out on this rally here on some of these tech names?
Yeah, in some ways I do, but in some ways I don't. Uh, I I know it sounds odd. I kind of have to like the business besides it fitting our 8 criteria for common stock selection. So I was on Facebook. I ended up with 850 friends. I was going to have to hire someone to wish people happy birthday each day. And then I started hating a lot of my friends because how inane and foolish they were. And I don't want to. I want to love them. I don't want to hate them. And so I just got off of it. I just got off of it. It was a rat race that I didn't want to be involved in. And of course, I'd seen the social network, and I'm not a fan of the I guess each business kind of has a soul. I kind of view, and I didn't like the soul of that business. And same thing with Google. I think they've been disingenuous. I think they've had major monopolies that the United States government should have got in front of, and they haven't. And it's hurting the country. But by the way, John Sherman and the people that created the Sherman Antitrust Act felt in the aftermath of the Civil War, when we were at each other's throats, right? We fought a civil war. They thought the most likely thing to ruin the United States was the concentration of capital in vast combinations. In other words, let me translate that: too much of the success in the society going to too few people. And look at where we are. Democrats hate Republicans, and Republicans hate Democrats. We spend all the time calling each other idiots. Okay. That is exactly why they've brought the Sherman Antitrust Act in. It's not a law. It is the act says there comes a time when the body politic could say, "Hey, it's just not good for the country that these people have these incredible monopolies. We got to bust them up." And we've missed the boat. I mean, we've gone so far into this now. We've ended up with everyone at each other's animosity for political reasons and populist. There's massive populism on both sides, and that is what Sherman was hoping to stay away from.
Well, do you believe that more populism is going to come? This is, by the way, I'm not sure if you're familiar with Neil Howe's The Fourth Turning, but that's one of the theses of his book, is that as we enter into a fourth turning, which is that every 80 years or so, there's going to be this generational crisis. Populism is going to be one of the recurring trends, which may or may not lead to changes in investment themes.
Investment themes to us have more to do with sticky customers and repeat business and strong balance sheets and the things that are in our 8 criteria.
Mm-hmm.
So you can imagine how hard it is for me to bypass something that fits our 8 criteria. Like at the end of 22, it was pretty obvious that Facebook was a cheap stock, right? And
Yeah.
and so again, I get that. I mean, I bought Microsoft in 2006, spent 6 years praying every night that Steve Ballmer would leave, and he didn't leave, and I sold it, and I never got back in.
When you see a year like 2024, when seemingly everything went up, stocks, gold, real estate, right? By the way, gold and the dollar typically don't move together in tandem, but the first half of the
Crypto.
year, they've
Yep.
done it the same. They both of these things move in the same direction. Inflation's gone down, interest rates gone down, so treasuries did pretty well, at least for the first half of the year. When everything goes up together, right? What's your initial impression on that?
Well, like Buffett says, investors become like Pavlov's dog. The market opens, and they come and eat at the trough of perpetual prosperity. And again, All recorded history defies that. All recorded history that you just don't ever get it's never been as good as the last 15 years, other than the last 15 years. It's never been this good. And if people want to be chronological snobs and think that somehow we deserve this because of how sophisticated we are, how much technology we have, they don't remember what happened in the aftermath of '99. And David, that's a subject I would like to share. Uh, Now that everybody's all in, Cole was in the Far East for 2 weeks, and I was in Europe for a week recently. All the rule is once the people farthest away completely buy into what is happening, that's when you got to be incredibly nervous. So in 2011, when you went to a Schwab or a Morningstar convention and Ivy Natural Resources and Matthews Asia had the double booths in the middle of the room because you had to have them to play the big brick trade, Americans were a long way away from China and were completely bought into the brick trade. And now, outside the United States, the core of the investment modality of the major institutions, family offices, private wealth, et cetera, is the S&P 500 index everywhere else in the world. That is the number one investment and the core of everyone's portfolio. So if something happens to make that turn sour, there is going to be a lack of liquidity. And for the younger investors that love your podcast, it's terrific, by the way, and thank you for having me. It is in 2002, 2003, you'd go to bed and Cisco was 60 the day before at the close. You got up the next morning and it opened at 45. Now,
Yeah.
that was a 25% drop in market cap, and no money changed hands. It did not put any money in the hands of the owners. It didn't come from sales between 60 and 45. It just dropped. It got eviscerated. 25% of the market cap got eviscerated. If there's no buyer when we get into the next bear market that centers in the financial euphoria of today, there will not be any pool of capital that can be the buyer if for some reason the biblical symmetry comes back into play.
I like you to explain to me and the audience, please, the three market crashes that you talked to me about last time and how that's going to play out now that we're entering the end phases of this euphoria phase. Now, let me just give you a bit of personal background here. So, when 2008 happened, I was in high school. I had no exposure to finance. Post 2008, we had the longest bull market in American stock market history. 2020, the pandemic was a blip. That was not, it wasn't a financial crisis induced by collapse of banks. That was a black swan, and markets, as you know, recovered very quickly thereafter. So I'm not people of my generation have never seen a real sustained market crash before. So when people come on my show and they're talking about, well, market crashes may be looming, I don't really understand that, to be
Yeah,
frank. I read about it in textbooks, but
yeah, yeah,
what does it look like? How does it
yeah,
start?
yeah. So, well, I'll just give you one example.
Sure.
The bull market of 82 through 87 uh, peaked August 25th of 87. And in 78 days, they took 43% off the S&P. And you can go back and look at the quotes and barons. Bill Gross, the bond king, was telling everybody that we were going to have a depression. Okay. So you're talking to, for example, you talked to Cole and myself. Uh, uh, I was had started a mutual fund on the third trading day of 2008. We had our capital chopped in half in 14 months. My teeth were kicked so far through the back of my head that you could see my teeth from the other side. Okay. And we were bullish and buying broken growth stocks. That's what was cheap at the bottom in '09. Lots of stuff was cheap, but the easy money for us was to buy low double digit multiples in Starbucks, Disney, Home Depot, etc. Broken growth stocks were what was attractive at that point in time. And so we made a pile of money in '09 through 15. We beat the S&P, I think 5 of 6 years, and just had stellar numbers because we were optimistic when virtually no one was optimistic. So today we're pretty fully invested, but own a portfolio that we think can hold up and make money in a decade that's likely to be a zero return for the S&P 500 index. And by the way, it shouldn't be surprising because the return from 99 to '09 was zero. And
Yeah.
and Buffett at the dot-com billionaires thing in '99 told the story that from 1964, see, until 1990, nobody even talked about the S&P 500 index because Jack Bogle had not popularized it yet. So the Dow was the measuring tool. Buffett said in '64, the Dow was 875. In 1981, the Dow was 875. You only made dividends for 17 years in a high inflation environment. Okay. But the economy grew 370%, 4.3% compounded over 17 years. The next 17 years after that, 81 to 98, the economy grew only 200% or 2.7%. So what's the point? The point is, are we in more of a 64 to 81 situation, or are we more an 81 to 98 situation? And the answer is the only way you're in an 81 to 98 is if interest rates are going to go down a whole bunch. And there's no way on God's green earth that you can take short rates very low without triggering another bout of inflation. It's almost impossible. And by the way, the only way to pay that money back it is to inflate your way out of it. If the federal government borrowed $12 trillion, the way you got to pay it back is to make $12 trillion 20 years from now to be half as valuable as it is now.
Speaking of the early 80s, I've heard this viewpoint on my show recently. Take a look at the Fed funds rate. So here we are, 2024, 1982, the Fed cut rates from 17 and three quarters all the way down to 10% in the span of a few months. Okay. That's 400 basis points in less than a year. What happened to the S&P in 82? It went from here all the way up to here. Basically went 135% in 3 years
Mm-hmm.
during this rate cut cycle. Now, 82 was also a period of early 80s was a period of high inflation, high interest rates.
Go
There was a
go back
recession.
go back on your chart. See here. Go back to 1970.
Yeah,
See those darkened areas, those two recessions.
yeah.
We went to is that the inflation rate? Oh,
This is
that's a Fed funds
this is the
rate.
Fed funds rate.
Look
Yeah.
at that. So we thought we had inflation licked in '73 when the Fed funds rate was down to what looks like 3%.
Or
And
yeah.
go backwards to your left. Go left,
Here,
right
yeah.
there. What was that?
3.3.
330.
Yeah.
330. Where are we right now?
We're much higher than that right now.
Okay, and then what happened is inflation reignited and they took it all the way up above like 12%. And
Hmm.
then inflation dropped back to 5% in about 1977. And then look what happened. I sold someone a 90-day treasury bill in 1981 at 18%. 90-day T-bill, 18%. And by the way, if you're in a state with income tax, that meant income tax free because McCulloch versus Maryland says that the state and the federal government won't tax each other.
Okay. So what you're saying is we haven't beaten inflation yet? Is that the core message of what you're saying here?
We are at that first decline in the Fed funds right
Right.
there.
Right.
We're in that. We're in that
Okay.
right now. Okay.
Yeah.
And what happened was they had to reverse it because inflation took off again like a cut cat.
Yeah. Some
And
some of this though was due to the OPEC 1973 oil embargo, was it not? Which we
uh,
don't have currently.
the Yom Kippur War, do you hear the rhyme? The Yom Kippur War.
Yeah.
Do you think for 1 minute, does anybody think for 1 minute that killing the leader of this terrorist group stops Iran from funding the terrorists? No. The only way for Israel to get to the root of their problem is to eliminate the person that's funding the terrorism. That is the only way. Do you think the Chinese don't think that it would be a pretty good economic stimulus to put a blockade around Taiwan and put a bunch of people, conscript people into the military and pay them really well? Look, I don't get to know what happens. What I do think, though, is we're at that first dip.
Mhm.
This is the first correction in inflation, and then it will reaccelerate despite the best wishes of the body politic, and we'll have to deal with that. And it's not going to be pretty. Uh,
Drunken Miller agrees with that viewpoint, by the way.
yeah.
Something people have told me inflation is going to come back for various reasons. What's your reasoning for why inflation will return, this March?
180 million people under the age of 40 means a lot of our best household formation is in front of us, and therefore it's too many people with too much federal government monetized debt that's going to chase too few goods. From 2017 to 2021, Americans invested $438 billion in ESG funds and ETFs, and they put $2 billion into oil and gas funds and ETFs, a ratio of 219 to 1. Now, which thing do you think is going to be the most scarce the next 5 to 10 years?
Let us know.
We think we haven't even begun to see where oil prices could go.
Let's talk about that. Okay. So let's break down the CPI. So we have here 2.4% is the latest reading. It's come down, by the way, for September. August reading came down. Let's break this down by the main components. Energy. Okay, we can talk about energy, but energy has been year on year declining. Gasoline has been deflationary. Natural gas natural gas is kind of flat. And if you strip out energy, let's take a look at food.
Well,
Food
go to
is still
electricity. Go to electricity while you're at it.
okay. Yeah,
Okay, so just let's stop and think about this. It
right.
says the electricity is going up 3.7%. Uh, isn't it interesting, David, that people are just jacked up about a utility restarting a nuclear plant,
Uh,
right?
right.
It, it, but that's because at a tiny little way they can produce some electricity. 40% of the electricity is made with natural gas. The price of natural gas is going to go up so much in the next 10 years. It's just spooky. It's spooky to think about. And the only reason it hasn't is because, well, first of all, it's bizarre because it's plentiful right now because someone is restricting the transporting of our natural gas outside the United States. I think they call it liquid natural gas. Jerry Jones, the owner of the Dallas Cowboys and a big natural gas investor, said 2 years ago that we're still in the first quarter on natural gas. So while they're jumping all over these nuclear plants, which is, I mean, it's legitimate to start them up again,
Mhm.
but it can't even begin to put a dent. We're going to shut down a whole bunch of coal-fired plants. And the only legitimate way to make up that difference is produce a lot more electricity with natural gas and maybe even putting gasoline into turbines, which is what they do when they get a blackout in California.
Okay. So electricity, by the way, it varies nationwide depending on where you are. So you think electricity costs are going to go up, especially with the electrification of things happening, more EVs rolling out and whatnot?
California is always a good thing to watch to find out what's going to happen everywhere else, right? They're always they're the ultimate hipster state. Everything happens to them before it happens to everybody else.
Okay. So they're a leading indicator for where electricity costs are going to go up, and based on their prices, I'm guessing it's going to be up. So let's take a look at the other components of CPI. We talked about rent. Okay, here we go. Shelter. Where is shelter? Um, Still up, right? 4.9%, but the trend is down. I mean, shelter, this is as you know, owner's equivalent rent, which is an actual rent. It's just what people think they're going to charge in rent. But do you think that the trend for housing is going to be deflationary or disinflationary going forward?
We have a chart that shows the number of homes built each year divided by population. It's a way
Okay.
better way of thinking about this. We're at about a little over 1 million new homes built in a 330 million population. The peak was when the baby boomers needed a house in 1972 and 1978. We built 1.19% of population new homes to satisfy that demand. And in 1978, we built 0.95%.
Yeah.
0.95% of 330 million is like well over 300 or 3 million houses. It would take 3 million houses to be built in a year to have an impact on what people are paying to buy a house.
Right. What do you think, by the way, of speaking of housing, what do you think of Kamala Harris's plan to build 3 million homes in a year? Um, Supply coming online, would that help with the affordability issue?
Well, the only way to get price to come down is to increase supply. The problem is you have to build these homes in places where employers need to move people. We joke, we own U-Haul. We think U-Haul, which is the leasing and storage company, we think they should buy Southwest Airlines slogan. You're now free to move about the country. Companies have got to take their employees to affordable places to live so Horton and Lennar and NVR can build a reasonably priced home. The average home in the United States sells for 420,000. We've got to get the employees where the average home is. They can buy the average home at 420. They can't buy a home in Seattle or San Francisco or most of the major cities, right? Anywhere close in. They have to go way out in the suburbs to find affordability. And rather than do that, you're seeing it now. People are moving to Indiana and Ohio. There's great colleges there, affordable houses. That's what's going to happen. By the way, the history of the United States is emigrants as well as immigrants, right? Our prior generations, they moved all over the country to find cheap dirt. And that's what the 180 million people under 40 are going to do. They're going to move all around the country to find dirt that's less expensive so that they can have a home. And by the way, this will be true in 30 years, just like it was 30 years ago. For the average family in the United States, the most likely source of net worth when they're 60 or 65 years old is home equity. It's a forced savings program. It's a wonderful tax deductible forced savings program on an appreciating an asset that appreciates nicely with inflation. And that was the most popular investment in the United States in 1980 for the average person, not common stocks. Common stocks had gone nowhere from 1964 to 1981. It was owning a home because it defended them against inflation. They locked in their rent. They had tax deductible interest on a appreciating asset, and they could borrow way more times what they had to put into it to get started. A forced savings plan. That is a great thing. And we don't talk about that very much anymore because people have completely lost sight of that. So getting higher personal wages and locking in your rent on and owning your own home are the two ways the average person can defend themselves against inflation.
Any other, speaking of this issues, any other products that may be good inflation hedges long term?
Well, I don't own it, but I think T. Rowe Price would say he bought a lot of gold back when we were in this situation.
Okay.
So I can understand why people are buying gold. I want my inflation protection from a productive asset
Well,
as opposed. as
It's
opposed to,
interesting. Gold was going up all year, and inflation was coming down. So I
yeah.
mean, that's people were buying gold for, I don't know if they're anticipating inflation to return or maybe it was high and now they're just buying late. A lot of it came from China as well. But it's interesting. So energy, we haven't talked about your outlook for oil yet. That is the last component of the CPI we haven't talked about. What is your outlook on energy? It's come down from its $77 a barrel just a week and a half ago. It's like 69 now. I think if I'm not mistaken, I think the energy markets is they're no longer pricing in them a significant Middle East escalation. What's your take?
Well, I'd love to know how much President Biden has bought back for the strategic reserve. You notice the complete and total lack of information on that. Uh, I mean, at one time he had to buy back like 90 million barrels at the margin. So I don't know. You know that those kind of predictions are not a strength of what we do. I will say this, that over the course of the next 10 years, I think it's highly likely that we will at least match where we got to in '08, which was about 145 or $150 a barrel. And at that kind of price level, these oil and gas companies that have practiced great financial discipline compared to their history are going to literally coin money.
Let's shift gears now and talk about the consumer strength. Retail sales data came in this week hotter than expected. The dollar actually went up on Thursday when news came out that the retail sales went up by 0.4% of the month, higher than expected. Um, Consumer sentiment right now was weak, actually. It was, if you look at the Michigan Consumer Sentiment Index, it's been going down. But then again, we have data that shows that they've been spending money. Is this just a case of people going back to school and buying things in September, or is this, continuing trend here?
People 50 to 80 are rich from the stock market and are kind of like Rick James. They can do what they want. Okay. So you got strength from 50 plus year old people after 15 years of their pockets being laced by one of the greatest bull markets in world history, not just US history. Millennials have waited later in life to get married and later in life to have children. So they've spent a lot of money on themselves before they had kids. And what happens when you get married and have kids? Your spending pivots from discretionary to necessity. And necessity is inflationarily more sticky than discretionary, right? In other words, if you're making a discretionary spend, you can worry about the price. If you got a if you need a second car, you just got to go get a second car. Uh,
Yeah.
so the inflationary aspects of a pivot from 25-year-old millennials 10 years ago that were going to Tuscany each year with spending on themselves to 35 and one kid and needing a crib or whatever. It's a different planet. Or their kid needs to go to a private school rather than a public school in the area where they live. And all of a sudden, a big old honking expense is staring them in the face. So necessity spending is way more powerful than discretionary spending. And by waiting later in life to cause those necessities, we've postponed them, but we haven't stopped them from existing. Necessity spending is good for the economy. That's why from 64 to 81, the boomers' necessity spending caused a strong economy in an inflationary environment.
So is it fair to say, Bill, that unless we get a major equities market correction or any financial sector correction, we are not going to get a slowdown in consumer spending, which would portend a recession?
Exactly. In other words, if the stock market stays good, you're just adding to the problem.
Uh,
Which I can just tell you that people that have gotten rich in the stock market are spending money. I live in a town, Paradise Valley, where it's watching people build $5 to $10 million houses right and left. You can just see it. It's common stock home building 101.
I mean, isn't that a signal for more bullish momentum, though, if that's the sentiment right now?
Real estate,
It's a
it works.
self-fulfilling prophecy, isn't it?
It works just the opposite.
Okay.
Okay. Uh, Bill Gates built a $60 million home on Lake Washington in 1999. The Empire State Building was built in 1929 and finished in 1930. Uh, what's now Devon Energy was Mitchell Energy built a skyscraper in Oklahoma City, and it finished in 2008 at $145 a barrel. In 2017 to 2021, more skyscrapers were built in Seattle, Washington than any major metropolitan area in the United States, and it was only the 16th largest metropolitan area. And a lot of those are empty. By the way, Amazon owns about 20 buildings in downtown Seattle, and I don't remember seeing them marking down their income statement for marking those to the market because they're not worth what they used to be.
Okay. So the bottom line in your newsletter that you wrote in terms of your outlook, you said today our Federal Reserve Board members are unlikely to thread the needle on the trade-off between inflation and economic growth. We talked about both of these things today. Any better than their Chinese counterparts handled things in 2011 to 2014. Extremely popular stocks, extremely popular industries get overinvested and doom the double boots in the center of the convention. What you're talking about is basically a coming down to earth scenario for some of these overinvested popular stocks. Tell us about the three crashes that are going to happen that are going to lead into a decade of, in your
Well,
opinion, low growth.
it doesn't even necessarily have to have a crash. I mean, the 64 to 81 phenomena had two major bear markets, one in 69.70 and one in 73.74. It's funny. I came in the business in 1980. Stocks were cheap. We had a 22% bear market in 81, 82. We took cheap stocks to hellaciously cheap stocks. We took PEs to six times earnings, right? The market was paying six times earnings, paying a 6% dividend, and nobody wanted it because you could get 14 or 15%. You could get 14% munis in 1981, 10-year munis at 14% tax free. Who the heck wants a stock? You had to make a ton of money after tax just to get even with that return, but not this time. So the point is you don't get to know the timing, but you doom yourself to a lost decade at some point. That's really our message. It is whether it be 29 through 42, or whether it be 69 through 82, or whether it be 99 through '09, you're guaranteeing yourself a lost decade in the stock market. And how many of the people that have come into it in the last 10 or 20 years have any idea that it's a very strong historical possibility that the S&P 500 will make nothing in appreciation over the next 10 years? How many
Well,
people think that that's a possibility?
that happened with the Nasdaq post 2001.
Yeah.
Took about more than a decade to recover to its pre-2000 highs. Okay, so what do we do then if we're going to get low yields for or low returns for a decade on stocks?
Well, first off, you have to own things that you think can make a positive return. You have to beat the 10-year Treasury, right? The 10-year Treasury will give you 4% taxable with no state income tax. You need to make more than that net of your cost. And in the 1971 to 81 episode and in the 1999 to 2008 episode, the only way to do that was in oil and gas, because what you had was a super cycle in commodities that was attached to what was going on. In the first case, it was inflation. In the second case, it was the brick trade. And we think that that's what you're going to have. So that's how you got to make your money in land that becomes more valuable, oil and gas that becomes more valuable, and in companies that can raise their price in the same way the longshoremen and the machinists have raised their price.
Do you see opportunities of undervalued industries right now, things that aren't in a euphoria?
Oh, sure. Uh, sure we do. I mean, I mentioned that healthcare. Merck is as cheap as it ever gets. And it's because they're worried that when they lose some of their patent on immuno-oncology in 3 years, they won't find something to replace the revenue. It's so funny. They they price Merck different from Apple. Both companies have to find a great product every 3 or 4 years that people are going to universally adopt. And Merck's been doing it for 105 years, and people have more confidence in Apple than they do in Merck. Uh, so we like that. We look at Target, and we know that they made a big mistake and failed going into Canada, so we bought it after that. And we know they made a big mistake offending their best customers with their displays in the store. And we think they probably have learned their lesson, and we think they can make a comeback. So Target trades at 14 times earnings, and Costco trades at 53 times earnings, even though they're both brands that the customers just love. That people like to shop at Target, people like to shop at Costco. They both have high return on equity, have great businesses. One's worth 14 times earnings, one's worth 53 times earnings. We like that kind of stuff.
I see. And actually, there was a huge influx to money market funds right after the Fed cut rates. People, I think, were expecting to for rates to go down even further, and they locked in on the money market. Did you do that?
Well, no, we don't do any market timing in our fund. Our cash position is typically is about 3%, and it's we keep enough money in our back pocket so that we can buy a new position, and we basically fill a role. Our job is to compound money over long periods of time at a rate superior to what people could get elsewhere. And so we have to sit through bear markets. Uh, and so really, what do you own that's the most susceptible to a bear market? And by the way, our biggest fear is that a negative feedback loop on the S&P 500 hits, and a few of our companies will get demonized, not because they've done anything wrong, but because they're very large cap companies and will feel the selling pressure of the S&P 500 index losing its muscle as being the dominant investment modality. Right. In other words, if 20% of the people that have come to rely on the S&P 500 index in the core sell, it's going to negatively impact the largest cap companies in the index more. So for us, that would be the Berkshires and the JP Morgans and the Bank Americas and the American Expresses. So that worries us. If that negative feedback loop gets going, you could get sold, not because the company's doing anything wrong, but because of how large a capitalization company it is.
Is there any final question? Is there any contrarian play to the mainstream equities markets that you would take right now, that would maybe run counter to tech stocks going up and just S&P hitting new all-time highs every single week?
Well, under the heading of AI is a legitimate development,
Hmm.
ultimately the biggest beneficiary is going to be whoever makes electricity.
Whoever makes, you mean utilities?
No, whoever makes it. In other words, uh, a dam is going to become more valuable. Natural gas is going to
Ah,
become more valuable. Gasoline is going to become more valuable
I
because you
see.
can use those to make electricity. A
Okay,
nuclear a nuclear plant becomes more valuable because you can make electricity.
so you're very bullish on commodities.
Very bullish on anything that has to do with making electricity.
All right.
But the purest play is 40% of the electricity is made with natural gas.
Yeah.
Yeah.
Okay.
And by the way, that might be the most out of favor thing that we're involved in. Our companies that make oil and gas, nobody wants them because they're not making any money on the gas side. In the Permian, they just burn off a lot of natural gas, right? They just
Mhm.
burn it off because nobody wants it.
Very good. All right. Thank you very much, Bill. I appreciate it. Where can we learn more from you? I think you have a radio show as well. Am I correct?
We have a podcast, a book with legs podcast. Cole's the
Yeah.
driver of that, and
Right.
yeah, we have one coming up. We interviewed Wilbur Ross, his new book, Risk and Returns. Fantastic book. I highly
Mhm.
recommend that to everybody in the investment business.
Okay, good. And then Smead Capital, we'll put the link down below. People can check out Smead Capital there. Thank you very much, Bill. We'll talk
Thank
soon.
thank you very much for having us.
And thank you for watching. Don't forget to like and subscribe and follow Smead Capital down below.